Well, it's a slow burn, Stephen. The dollar still dominates global finance, if you think about it. About 90% of FX transactions, 66% of international debt, 58% of reserves, 48% of SWIFT payments. So no other currency comes close in liquidity or infrastructure. But I would say the cracks are appearing.
This is Converge,
a podcast from Convera.
Come with us as we shape the future of finance.
Hello and welcome to the Converge podcast. And my name is Stephen Dooley. I'm the head of market insights, and I'm joined today by Shirley Lim, our lead FX and macroeconomic analyst out of Singapore. Shirley, thanks for joining the podcast today.
Thanks, Stephen. It's a pleasure to be here, especially at such a pivotal moment for currency markets.
Absolutely. And we explore this pivotal moment in currency markets in our Are You Ready for 2026 report, which we've just published. And we've got you on today because you led the research into one of the major sections of the report, the US dollar on trial. And the reason why we've covered that is because global currency markets have delivered a spectacle rarely seen in modern finance, where US stocks, bonds, and the US dollar all weakened together while gold shot to new highs. The triple move left many asking, is the US dollar, long the world's ultimate safe haven, losing its crown? Or is it just another chapter in a long story of resilience and adaptation? So you're here today to unpack what's happening with the greenback. So let's set the stage. 2025 has been a whirlwind: trade wars, tariffs, market whiplash, and now questions about the very foundation of the US and global financial system. Take us inside the moment. How did we get here?
Yeah, it really has been a roller coaster, Stephen. 2025 saw a convergence of shocks that tested every assumption in the playbook. The US administration's aggressive tariff strategy upended global supply chains and sent volatility through the roof. After Liberation Day, US equities plunged in one of the steepest declines on record. The VIX shot above 50, rivaling the peaks of the pandemic and global financial crisis. Meanwhile, the US dollar posted its worst first half performance since 1973, dropping over 10%. And that's a dramatic break from its historic resilience as a safe haven. Gold, on the other hand, soared as investors scrambled for cover. But the real shock was a simultaneous sell-off in US stocks, bonds, and the dollar. Traditionally, when fear takes over, money rushes into the dollar and the treasuries. This time, both faltered. So that's what led to an existential debate. Is the US dollar safe haven broken? Or is something deeper changing in the rules of global finance?
Okay, so let's get to the heart of it then. Why did the US dollar's safe haven break down last year? What changed in the mechanics of global markets?
There are a few layers to this, Stephen. First, the nature of this year's shock was unique. The US tariff escalation delivered a stagflationary jolt, spiking inflation before demand had a chance to drop. In the past, a classic global restock event will crush demand, drive investors into US assets, and send the dollar higher. But this time, US inflation spiked, real incomes fell, and the growth outlook dimmed. Demand for US assets, especially equities, remained strong, but the dollar failed to rally. Second, policy uncertainty in the US soared to new heights. Tariffs, fiscal expansion, and the threat of punitive Section 899 taxes on foreign investors injected a brand new risk premium into US assets. The market started to demand extra compensation for holding US debt, and the old negative correlation between equity volatility and the dollar actually broke down. Instead of rising with risk aversion, both the dollar and US yields fell, something we haven't seen in decades. Third, it wasn't a mass exodus from US assets that drove the dollar down. Instead, non-US investors, especially in Asia, hedged their dollar exposure using FX swaps and forwards. This hedging, rather than outright selling, created downward pressure on the dollar, particularly during Asian trading hours. So this was a story about risk management, not abandonment. Investors weren't dumping treasuries, they were insulating themselves from US policy risk.
Interesting. So that's a real nuanced point, isn't it? It wasn't so much a vote of no confidence, but more a shift in how risk is managed.
Yeah, exactly. And here's where the dollar smile comes in. For years, the dollar smile framework helped us to understand the dollar's behavior. The dollar tends to be strong in two scenarios, either when US economy outperforms, which is the right side of the smile, or when global risk aversion is high, which is on the left side of the smile. In the middle of the smile, when global growth is solid and risk is low, the dollar weakens as investors seek yield elsewhere. But 2025 threw a wrench in the model. Normally, a risk-off event will put us on the left side of the smile, dollar up, as investors seek safety. This time, bad news was US-driven, with policy uncertainty and stagflation weakening the traditional safe haven channels. So instead of rallying, the dollar declined, even as volatility and uncertainty spiked.
So let's explore that a bit more, because I know not everyone is familiar with the US dollar smile. Walk us through what that is and why it helps explain US dollar dynamics.
The dollar smile is a framework that visualizes the US dollar's behavior as a function of risk and growth. So let's imagine a smile curve. On the left, bad news about the world, geopolitical shocks, financial crisis, pushes investors into the dollar for safety, strengthening it. In the middle, with synchronized global growth and risk on sentiment, capital flows to higher yielding or riskier assets, so the dollar weakens. On the right, strong US growth and outperformance attracts capital, again strengthening the dollar. Historically, the smile has been robust, but a twist in 2025 was that US-specific shocks, policy risks, tariffs, and stagflation pushed markets into risk-off mode, but instead of the dollar rising, it fell. Why? Because the bad news was homegrown and the global rate spread dynamics didn't favor the US. Investors hedged, not fled, and the traditional shortage of dollars in a crisis didn't materialize.
Right. Thank you for that. I mean, it brings us to the second big question that we explore around the greenback. There's a lot of noise around de-dollarization, that focused move away from using the US dollar by either governments or businesses. Are we actually seeing the world move away from the US dollar?
Well, it's a slow burn, Stephen. The dollar still dominates global finance, if you think about it. About 90% of FX transactions, 66% of international debt, 58% of reserves, 48% of SWIFT payments. So no other currency comes close in liquidity or infrastructure. But I would say the cracks are appearing. Central banks, especially in emerging markets, are diversifying reserves, not dumping dollars, but reducing concentration risk. We're also seeing more commodities priced in non-dollar currencies, so think the Russian and Chinese exports. Digital currencies and alternative payment systems are on the rise and gradually chipping away at the dollar's monopoly. However, the shift is evolutionary, not revolutionary. The euro has inched up as a reserve asset, but is capped by institutional constraints, no fiscal union, fragmented bond markets. The yuan's progress is stymied by capital controls and limited convertibility. Even as foreign buying of US assets hit new highs in 2025, the dollar didn't rally, signaling that capital flows alone no longer dictate the dollar's direction. Policy credibility and risk premiums are now front and center.
That's fantastic. Thank you. So let's bring in the Asia Pacific perspective. How did that US dollar smile play out in Asia, and what does it mean for regional currencies?
So, great question. The dollar smart framework helps explain why Asian currencies showed historic strength this past year. Normally, a global risk-off will see the dollar surge against emerging market currencies. But with the US at the epicenter of the shock and with investors hedging rather than abandoning dollar assets, Asia's FX outperformed, led by the Taiwan dollar and others. In fact, the pattern was clear. North Asian currencies with higher trade exposure to the US outperformed as the repatriation of US assets and hedging became dominant forces. The shift lower in US dollar CNY fixings, despite China being at the center of the tariff storm, reinforced the idea that FX policy and financial flows were now in the driver's seat. So this is a practical example of the dollar smile morphing. The left side of the smile, normally strong dollar and risk off, was muted because the risk was US-centric and Asian hedging flows cooled the dollar down.
Interesting. So the US dollar smile is still there, but maybe the teeth aren't as sharp when the US is the source of the problem.
Yeah, that's a good way to put it. The dollar smile is alive, but the center and left have flattened for now, making the smile more of a smirk. The implication for global FX is the regional stories like Asia's export recovery and currency hedging can dominate the narrative when US policy is the main source of risk.
Well, thank you, Shirley, for such a thorough tour of the landscape. Any final thoughts for us today?
Yeah, sure. So I would say that it means more volatility and less predictability. And I do think that managing FX risk is now more than just tracking interest rate differentials. This is about scenario planning, stress testing, and understanding the shifting sands of policy credibility and risk premiums. The dollar remains king, but its court is restless, and the rules of succession are being quietly rewritten. And the dollar role isn't over, but it's being renegotiated in real time. The dollar smile still matters, but the world is learning to read its nuances. And in 2025 and beyond, it's the subtleties that matter the most.
Very well said. Well, thanks again, Shirley Lim, our lead FX and macro strategist out of Singapore. Appreciate your time today, and thanks a lot for being on the podcast.
Thanks, Stephen.